Hey, it's Brian Price for Real Vision. Today, I'll be speaking with technical analyst Mark Newton of Newton Advisors. Let's see what he's looking at right now. I want to drill down a little bit on what we're seeing in the last couple of weeks. You've described the action as schizophrenic. Explain that.
Yeah, well, it's really a tale of two different markets. Large cap technology and retailing really have carried this market for the last few months, whereas the broader market really has not participated. So you've seen, deterioration in sectors like industrials and materials, which have all been abysmal for the last few months, whereas most of the media seems to be talking about Facebook and Google and Amazon and everything's hitting new highs and everything's great, where in reality the market really has not gone anywhere when you look at things like the New York Composite, which has largely been sideways over the last few months. So for me, it's an interesting time with the trade wars heating up, more and more pressure on different parts of the world outside the US as well, Europe, Asia, and bond yields similarly have been not really responding to the Fed's idea that they're going to continue to hike, and they've actually been dropping of late. So it's interesting when you look at, what's the future hold for stocks at a time when we seem to be going in a few different directions. So it's really important to understand the sector rotation and really what's taking place, because it's certainly more than just FANG stocks per se and the NASDAQ hitting new highs every day.
So why is tech not particularly attractive to you right now?
We've reached really stratospheric levels of really what we as technicians call momentum. We've gotten very, very overbought. And so when you start to see things get very stretched and all of a sudden start to wane, most of these stocks have been up 25 to 35% in the last few months when you look at Facebook and Amazon. And so those don't have as much appeal to investors really as we enter what's commonly known as a very seasonally challenging part of the year. So historically, June has been the worst month of any within the midterm election year. It's really number 12 of 12. It's really the worst month. It averages about minus 1.7%. So a couple of weeks ago, we saw really a situation when tech stocks had been gaining ground, but yet the month really had not been obeying the June traditional seasonality. So we saw sentiment getting extraordinarily complacent, people buying calls almost at a 2-to-1 ratio of puts. So that's a little bit, for me, it represents a time when one wants to be a little bit more defensive and very much not press your bets, particularly in sectors like technology. So the long-term future obviously is great for tech, as we all know. Many of these companies are doing some extraordinary things and changing the way that you and I and everybody does business. But really it's more of separating out the companies from the stocks and saying, are the stocks really at a level when we want to be stepping in, initiating new positions? For me, I think the answer is clearly no. And so I look at technology versus the S&P and seeing relative signs of the sectors starting to peak out a little bit. And just in the last day, we've seen the NASDAQ 100 really break its entire uptrend that had been intact for the last 2 months. So technically, for those that are not technically proficient, that is really a sign that you want to really pay attention, that the NASDAQ had been resilient. Now we're starting to join, potentially pulling back to join some of the weaker sectors, as opposed to thinking that tech is high and the other sectors should now start to follow suit. It's actually, tech is starting to join the others to the downside. So for me, that's a little bit of a concern.
So this helps me segue into your trade today. Let's assume folks at home agree with you and are a little nervous when it comes to the action we're seeing in tech right now. You're a fan of healthcare, one of 4 positive sectors in 2018. Why?
Healthcare gained, I think, over 2% thus far for the month of June up until today's pullback. And in general, that makes the sector really start to show more and more signs of strengthening in terms of momentum. Trend analysis shows things like the XLV, the ETF for healthcare, starting to show very good signs of strength. So technically, that's part of it. Sentiment is another part of it. In the recent portfolio managers report from B of A, Merrill Lynch, they came out and said that healthcare was really one of their least preferred sectors. And so whether it be concerns about healthcare costs going forward or Obamacare, how this whole thing is going to potentially be resolved, more people now retire more than working for the first time ever. Ongoing concern about healthcare costs and really what's going on with drug pricing. That seemed to be a favor that was very much out of favor for portfolio managers as of just the last couple weeks. My thinking is that's exactly the time when you want to take those laggards, those sectors that are out of favor when nobody likes them, and say, technically the sector is still in good shape, but it's just underowned and underappreciated. Nobody likes it at this stage. So for me, it was in an area where I thought it could really start to do well. So outside of the technicals, outside of the sentiment, seasonality right now favors healthcare to actually do well over the next few months. Historically, pharmaceutical stocks have done well during times of market crisis. We've seen the biotechs run up to new all-time highs. When you look at ETFs like the XBI for biotech, the S&P Spider sector. So the drug area is one where we ought to see some of these stocks start to play catch up. And we've begun to see that with some regard to the biotech stocks. Some of these laggards like Regeneron and Alexion, CVS, Allergan, all of these have now started to bounce and show over 5% gains in just the last few weeks. So for me, it's a sector that nobody's looking at. Everybody's looking at tech, and they should be looking at healthcare as it starts to show meaningful outperformance during seasonally a very challenging time for the market.
So you're a technician. Let's drill down on the charts. Let's keep it to where I know you're most comfortable. As far as what we're seeing with the XLV versus the S&P, we've broken through a downward trend, a 9-month downward trend. How do the charts speak positively to your thesis?
Well, that's one of the main ways that investors, I think, can get a grip on what's happening with the market, is not necessarily looking at daily or weekly charts of things like XLV, but actually studying how the relative charts shape up. And to your point, XLV in the last couple of days has broken out of a long-term downtrend of healthcare versus the broader market. So for me, that certainly sets off warning bells that, for those that are not participating in this sector, that you really want to start to get involved. On an absolute basis, XLV just broke out last week, really to the highest level in more than 2 months. So it certainly is getting interesting technically, and it's one that you really want to own and continue to overweight, I believe, in the next couple months.
Levels. We're trading mid to low 80s right now in XLV. You think we can get up to 89 approximately. Is that correct?
I do, and the next month potentially could still be challenging for the broader market, and so to see gains of anywhere from 5% to even potentially 10% of some of these laggards start to snap back in greater fashion, that would be a very encouraging sign for the sector. So I like it on an absolute basis. I think XLV can move higher. The market has been weak prior to the big holiday next month, but I think there's signs that this could lead to fear and potentially a short-term bottoming, and in any rally to come, I think healthcare is going to be the sector that leads us out of that. So I'm bullish for a move to the upper 80s. There's a level right near 89 that's important. Above that's right near 92. So I'm long here. I like buying healthcare, and I'd really use any minor weakness as a chance to average down and buy more.
Moving below minor weakness, though, what's your stop loss on XLV?
Well, anybody should use a stop of really no greater than really 5%, for trading purposes, and you never want to let positions be greater than really 1 or 2% of your investable income for anybody that's taking on positions like that. But so really at these levels, I would just simply use May lows, and really a break of that would really be of concern to me, and think that XLV could potentially fall further. But that's truly an alternate scenario. The sector has shown very good signs of strength, and so use a 5% stop, and as it starts to work, you simply move that up and use a trailing stop on gains.
So Mark, I want to call an audible, and I want to add in a second trade in addition to this conversation. You mentioned a couple of individual names, got my mind working a little bit, specifically Regeneron.
Right.
If you want to look in addition to an ETF, find an individual name in healthcare. You like Regeneron, and you anticipate some really big gains there. And I just want to give a little bit of background. It's a cheap name, PE of about 26, monster name, $35 billion market cap. Where are we at right now, and where do you think things could go in the next couple of months?
So Regeneron is really one of these stocks that has been a laggard for some time, up until the last few weeks. A few things have happened in recent weeks. So technically the stock not only has broken out above its longer-term downtrend that we've seen for the last 9 to 12 months. During that time, Regeneron lost, I believe, north of 40% from its peak last fall to the recent low in early June. So we've seen some recent strengthening in the stock, and that's been encouraging. You've also regained prior lows that were seen a few months ago when the stock tried to bottom out. So, this is one of those stocks where I believe the mean reversion trade should start to work as healthcare as a group starts to show greater and greater signs of momentum. So I would certainly buy the stock here. I recommended it in my weekly technical perspective this week as one of really the 5 top healthcare stocks to consider, really from a risk-reward standpoint. And technically, it's starting to show signs of shaping up. And I believe that rising tide carries all boats, and if healthcare is going to work, it's probably better during challenging market times to look for some of these laggards that have started to show greater signs of momentum of rising off the lows.
So a rough session takes it down in about the 320s. However, you think on a couple of rallies we could get as high as 409.
Yeah, it certainly seems like an aggressive target, and you can't say that it's going to get there anytime soon, given the extent of that move. But it's also lost, almost half its value really since last fall. So that's, in the bigger scheme of things, I think that's an eventual intermediate-term target where the stock can get back to there. And some of that's going to depend on the market, stabilizing a little bit and showing some stability given the trade fears for the stock and the sector to work on an absolute basis, but on a relative basis, it's very appealing to me at this time.
And that's within about 6 months before year end.
I agree with that, but I really think going forward, really healthcare is one for investors to consider overweighting, just given the demographic trends that we're seeing right now. I think, over time, when you look at the top stocks that have shown the best performance over time, and many of them come from the healthcare arena, be it Johnson & Johnson or Bristol Myers or Pfizer and Merck. These have been consistently strong stocks over time. The biotech sector just hit new highs, and Regeneron just happens to be one of these stocks that's lagged of late, but yet they have decent earnings growth. And as you mentioned, they have a PE of 26, which is low based on its standards, I believe. And as we all know, I'm not a fundamental analyst, but I know a few bits of why the fundamental people seem to like this stock here, and I can finally weigh in and really join that call from a technical perspective.
Thank you so much for joining us.
Thanks for having me, Brian. Appreciate it.
So Mark says healthcare is attractive with relative strength starting to build. He likes the ETF XLV and the individual name Regeneron, ticker symbol REGN, as we're seeing downtrend line breakouts in both. Ultimately, Mark sees a 4 to 5% increase for the XLV to $89 and a 25% gain for Regeneron to over $400 if his thesis plays out. His stop loss for both would be 5% down from current levels. Thank you so much for watching. For Real Vision, I'm Brian Price.